All right, so we're in week 9 of the semester. We're now in the second half material. In the first half of this course, we looked mostly at contextual content. I gave you a lot of background information in the way of the history of social welfare policy, in the way of the economic context, in the way of the political context, diversity issues, and how poverty is defined, explained, and measured and such. In the second half of the semester, we'll look we'll look a little more in detail at different policies and programs. And so we'll take a sample social insurance program, we'll take a sample public assistance program. We'll look more closely at specific programs, essentially, in the second half material. So first, just a quick outline of what I intend to cover in this particular lecture. This lecture will be broken up into 2 parts. In the first part of this lecture, we'll look at old age survivors' disability insurance. That's, of course, the name given to our Social Security system. And so we'll look at eligibility structure, how one becomes eligible. We'll look at the benefit side, how the benefit is determined. And then we'll look at one of the primary policy issues, which is having to do with the financing or the solvency of the program. And then in the second half of this lecture, we'll take a sample public assistance program, and specifically we'll look at temporary assistance for needy families. That's a current name given to our welfare system. So we'll look at its history. There's a very rich history, so we'll take a look at that history fairly briefly. And then we'll look at some of the stated purposes of the legislation, the most recent legislation implemented in 1997 and reauthorized in subsequent years. Well, this is a block grant program, TANF is. That is, the federal government provides lump sum payments to the states, giving the states some latitude in the way they administer the TANF program. And so we'll look at some of those, subject to certain requirements, so we'll look at some of those major conditions or requirements by which the states must comply with which the states must comply. And then we'll look at some basic outcomes since implementation back in 1997. But first, let's take a close look at Social Security or Old Age Survivors Disability Insurance, OASDI, which is Title II of the Social Security Act. The Social Security Act, the structure of the Social Security Act really hasn't changed that much since 1935. We can see that Social Security is still Social Security. It's still Title II. It was Title II in 1935. It's still Title II today. We added a survivors component in 1939. We added a disability component in the 1950s. If you want to include some of the health programs, if you want to include Medicare in that discussion, we added the health programs, Titles 18 and 19 in the 1960s. But we're going to be looking at Title II, unemployment insurance. Another social insurance program is still Title III. It was Title III in 1935. It's still Title III today. TANF we'll look at in the second part of this lecture. Of course, that was had a different name back in 1935. And then we have some different child welfare programs, foster care notably, very interesting program, Title 4E. And of course, our health, I noted 18, 19, and 21. 21 is a CHIP, the Children's Health Insurance Program, which is a supplemental public health insurance program, and then SSI program for persons who are with disabilities, who are blind and aged as well. But our focus here is on Titles 2 and 4A. So just a quick review of the nature of social insurance programs. We know that social insurance programs are in fact universal. That is, anyone could potentially benefit from social insurance programs as long as you made the required contributions. We know that social insurance requires contributions. As long as you made those contributions, you could potentially benefit, rendering them universal in nature. Of course, if they're universal, they're not selective. They're not going to be means tested. There's simply no income and/or asset test for social insurance programs. And of course, it's financed. Social insurance programs are financed differently. There's dedicated earmarked funding. We have a FICA tax that goes towards payment of benefits for social insurance programs. And then, of course, there are some private insurance market problems that if we left social insurance up to the private market, that we may run into issues of moral hazard or adverse selection. We noted before that organizing these programs via the government, via social insurance, tends to overcome, or it's reported that we overcome issues of moral hazard and adverse selection via social insurance. So some basic characteristics. Just a quick poll from the New York Times in years past about what the public sentiment might be towards the solvency of Social Security, whether or not you think it's going to be there when you retire. So currently the retirement age is 66. By the time we all retire, it'll be 67. The full retirement age goes up 2 months each year. There is a period in which it stays the same, but eventually it'll reach 67 by the time we retire. And so the possible responses here are A, by the time I retire, I'm not going to receive any Social Security benefits? Or do you think B, by the time you retire, you're going to get less than half of what current retirees with similar earnings history receive? Or do you think C, you're going to get back somewhere between a half and 100% of what current retirees receive? Or do you think D, you're going to get back 100% of what current retirees with similar earnings history receive? And so I'll let that sort of soak in for a second there, and you can formulate your response. But I can tell you now that when this poll was administered back in 2006, that more than 50% of respondents answered either A or B. So the public sentiment tends to be that most people think Social Security is not going to be there when they retire. And so as we make our way through this discussion, you can think about whether or not the program will be there, depending on the tweaks that we need to make in terms of the fiscal realm in which Social Security currently resides. All right, so just a little bit about how the program actually works. So in terms of eligibility, we note that it's a contributory scheme that Social Security relies on. You have to make your required contributions, and that contribution is going to be 6.2% of your earnings. But not all of your earnings is going to be taxed for Social Security purposes. There's a capped amount that goes to Social Security. So that capped amount is $117,000 for 2014. That amount changes each year depending on what the average wages are for that year. So whether or not there's an increase in average wages. And so you'll note that you have to make that contribution for over your lifetime, essentially, right? So if you accumulate 40 credits, so 40 credits corresponds to quarters. That credit system corresponds to quarters of covered employment. And so if the program requires 40 credits of contributions or quarters, you can do the quick math and figure out that it's going to take at least 10 years of full-time employment to become eligible for Social Security retirement benefits. And so you'll note that there's different ways in which one becomes eligible in terms of the categories of workers that become eligible. You can claim your benefits based on your own work history as a retiree. You can claim benefits. You can claim spousal benefits, that is on your spouse's work history. And then you can also claim benefits as someone with a disability. So different ways in which you may become eligible. And the ages at which you become eligible are different. For a full-time worker, that age is 62. You can claim benefits as early as age 62. As a spousal, in terms of the spousal benefit, you can claim as early as age 60. And the disability benefits you can claim as early as any age, really, before age 65. So just to know that there's different ways in which you can claim benefits, you can claim your Social Security retirement benefits. All right, so not necessarily from the perspective of an individual worker or from the perspective of the family unit, but looking programmatically, right? So thinking about the program as a whole and how it's financed. We have the Federal Insurance Contributions Act that mandates that the federal government collect 6.2% tax for Social Security purposes and also 1.45% tax for Medicare purposes. And so that tax is assessed not only on the worker, himself or herself, but also on the business as well. So that 6.2% is matched by your business or your employer. So essentially it's 12.45% tax on the capped amount. And then note the distinction with Medicare. Medicare taxes are not capped. And so it's 1.45% tax on all earnings as opposed to just up to capped amount. And also note that this is a tax on earned income as opposed to unearned income. The law makes a distinction between earned income. So examples that the Social Security legislation might give. If you work for Starbucks, right? Of course, that's earned income. If you're self-employed, that's earned. If you published a book, you're collecting royalties, that may be considered earned. If you're a person with a disability and you're working at a sheltered workshop, that's considered earned income. And of course, other types of income are unearned. And so the note here is that this is a tax on earned income as opposed to unearned income. All right, so a more important note here is that Social Security is a pay-as-you-go system. Right? So pay-as-you-go means that current workers will pay for current retirees. So by the time you retire, if you're really relying on this benefit that you may claim when you get to retirement age, this is going to depend on whether or not there are enough workers that are paying the system. So it's not an individual retirement account system that many people envision. It's not that you have your own retirement account that's being managed by the federal government with your name on it That's not how it works. It depends on the number of workers that we have at any given time. And so just keep that clear. So it's not a piggy bank system. In other words, it's a pay-as-you-go system that I note here. All right, so very important in terms of thinking about the policy, the fiscal challenges with respect to this program. I ask here facetiously somewhat, so how progressive are the Social Security taxes? That's the basic question here. And we note that we've noted 3 different types of Social Security, or not just Social Security, but taxes in general. We have progressive, regressive, proportional, and of course that all depends on the rate of tax as you increase income. Does the rate of tax increase as you increase income? Does it decrease, or does it stay the same as in the case of the proportional or the flat tax? So that's the question that we're trying to ask. Is it proportional, progressive, or regressive, the Social Security tax that we're looking at here? And so let's take a close look here. Let's imagine that we have 3 classes of workers. You have one person who makes $30,000 a year. You have a second worker who makes $117,000 a year. And then you have a third worker who makes $500,000 a year. And let's assess whether this tax is progressive, regressive, or proportional. And so we know that for that $30,000 worker, that $30,000 worker is going to have to pay 6.2% of his or her earnings for Social Security purposes. The second worker, the $117,000 worker, is also going to have to pay 6.2% of earnings for Social Security purposes. And so up to that point, up to that $117,000 worker, if you're asking yourself, is the tax rate progressive, regressive, or proportional? It seems to be proportional at this time, certainly, or flat, right? It doesn't matter what level you are, you're going to pay 6.2% up to that amount. But of course, you have to figure the higher income worker. So that $500,000 worker, this is, so I just spotted an error here. That should not be 1.37%. That should be 1.45%. So the $500,000 worker will pay 6.2% of earnings up to $117,000. And so I show you the exact amount. $7,254 is the maximum Social Security tax that's going to be paid for 2014 because we have a capped amount, right? And so if you're assessing the amount of tax paid as a percentage of total earnings of $500,000, it actually comes out to 1.45% in the rate of tax that's paid for this $500,000 worker. So that should be, of course, 1.45%. So ask again if this is in fact progressive, regressive, proportional. We know, of course, that this is in fact regressive in nature. The higher income worker pays a much smaller percentage of what they made that year relative to the lower income worker. So we know that this is a regressive tax. The Social Security tax is in fact regressive in nature. Now let's look on the benefit side. We're checking the benefit side and how the benefit is determined. I'm not going to ask you to calculate the benefit, but you should note how the benefit is calculated. I'm not going to ask you on the exam, but you should know how it's determined. So I note here that the Social Security Administration will take your highest 35 years of earnings. Okay, so they're going to take your earnings history, take your highest 35 years of earnings, and try to figure out what you made on average per month of your lifetime. And so that monthly amount is more formally stated. It's called the average indexed monthly earnings amount that they're trying to calculate, or AIME. So once the SSA or the Social Security Administration calculates that AIME, or the average indexed monthly earnings amount, they split it up into 3 different levels. They split that AIME up into 3 different levels. On the lowest level of earnings, you're going to get back 90% of what you used to make over your lifetime. On the middle level, you're going to get back 32% of what you used to make. And on the highest level, you're going to get back 15% of what you used to make. And so that's what I'm showing here. By lowest level, I'm talking up to $816 of your average index monthly earnings amount. You're going to get back 90%. And so note that these bend points, $816, that amount will change each year depending on changes in average wages. These percentages, these replacement rates will stay, they're codified by law. They're not going to change in the near future. These percentages stay the same, but these bend points differ from year to year. So 90, you're going to get back, so that was just a little side note, but you're going to get back 90% of your lower level earnings on mid-level earnings. And what mid-level earnings means for this year, anything between $816 and $4,917 in the way of your average index monthly earnings amount, you're going to get back 32%. And then on AIME, over $4,917, you're going to get back 15%. Right? So that's the basic structure of how the benefit is calculated And then once you add those amounts up, once SSA adds those amounts up, that's called your primary insurance amount. The primary insurance amount is just your starting monthly benefit, and so that starting monthly benefit, your primary insurance amount, is adjusted annually for changes in prices. There's an automatic adjustment that goes into effect. So I just show you here in numbers what I just explained to you in plain language, just as a quick example. So assume that you have a worker who made $5,000 on average over his or her lifetime. So they figured AIME to be $5,000. So you're going to get back 90% of the first $816 of your AIME. And I show you the amount here, $734 and change. And on mid-level earnings, so the difference between $4,917 and $816, which comes out to $4,101, you're going to get back 32% of that AIME, which is this amount. And then on your AIME that exceeds $4,917, which is, of course, $83, you're going to get back 15%. That's this amount. So add those up. And a person who made, on average, $5,000 over their lifetime, in 2014, their starting monthly benefit will be $2,059, assuming that they claim this benefit at full retirement age. So there's a reduction in the primary insurance amount if you claim early retirement benefits, and of course it'll be a little bit higher if you claim later than your full retirement age. So, and of course I noted that primary insurance amount is going to be adjusted for inflation. There's an automatic cost of living adjustment, or COLA is what it's called more formally. All right, so big picture. So the basic implications of how this benefit is determined. So workers with a lower earnings history over their lifetime are going to get back a higher percentage of what they used to make relative to the higher income worker. And the workers with a higher earnings history, they're going to get back a lower percentage of what they used to make relative to the lower income worker. And so if we're assessing once again, right, whether it's progressive, whether the benefit determination is progressive, regressive, or proportional, we noted that the tax structure seems to be regressive. It's more favorable for the higher income, the $500,000 worker. But in terms of the benefit determination, it seems to be more favorable for the lower income worker that gets a higher percentage back of what they used to make. So we note that this is one of the reasons why Social Security remains so politically popular, is that it seems to appease both the liberals on the benefit side at least, and then of course the more conservative-oriented persons on the tax side. And so this is just a note about the automatic adjustment that I show here. So there's an automatic adjustment in the starting monthly benefit amount. So it's based on the Consumer Price Index for hourly workers. And so this is, if you're interested in the economics behind this, you can check, you can Google CPIW versus CPIU. This starting monthly benefit amount used to be indexed to the CPI, the Consumer Price Index for all urban consumers, which covered a broader category of workers. But now it's indexed to the CPIW, which is a more narrow category of workers, that is hourly workers. And so adjusting for the CPIW, 2013, the change in the Consumer Price Index between 2013 and 2014 was 1.5%, according to the CPIW, which is lower than what the change was for under the CPIU. And so you can see how the government is attempting to save a little bit of money by shifting to this different Consumer Price Index. All right, so this last section here is sort of the big picture, the policy discussion about criticism and such. There are criticisms of Social Security both from the left and from the right. I don't really side with either of these arguments, either from the left or from the right. I don't know why you'd want to criticize Social Security from the left. It's a very generous program, but the basic nature of the argument is that we're not even doing enough, right? So that we tend to have Social Security for those with the earnings history, and then we have a different tier of benefits or social welfare for those without our earnings history. That's our welfare system. And so essentially, it's not an argument for expansion of Social Security as it is more an argument for expansion of our welfare benefits or our public assistance benefits for those who don't have the earnings history that's required for our Cadillac Social Security benefits. So if you want to check out this argument in more detail, you can check out the book called Pitied but Not Entitled by Linda Gordon. who's more left-leaning, and she's criticizing Social Security for the two-tiered system that it inadvertently has created. Of course, we always have criticisms of Social Security from the right, from more conservative-minded persons and scholars and analysts and politicians and such. We adopt many of the proposals from the right. We've adopted these. Over time, we've adopted the Greenspan Commission proposals during the Reagan administration, increasing retirement age to save money, taxing the benefits. We've done that over time, taxing benefits more aggressively over time. We've adopted some of these proposals. Some we've not adopted some proposals. So the Bush proposal, this is a younger Bush that I'm talking about, but President Bush had proposed that contributors, that workers, be able to take 1/3 of that FICA tax that they pay, that 6.2%, and then put that into a private retirement account that would be administered. There weren't really any details about it, but that they could take 2.1% and contribute to a private retirement account. But this really didn't gain any sort of momentum, and the proposal was shot down eventually in Congress. But so some of these proposals we've adopted, others we haven't over time. All right, so the current challenge. So looking at the current policy context, we have a financing or fiscal challenge here. That is, we're not going to be able to pay out the benefits, presumably, at some point in time. And so the basic nature of this financing challenge is the worker, or the crux of this issue is in the worker to beneficiary ratio, or sometimes called the dependency ratio. So the dependency ratio is a little bit different, but sort of the same idea, similar idea. But this system is relying on the number of workers, I said before, to each beneficiary. So the worker to beneficiary ratio, for Social Security purposes, we had, if we go even further back, I showed you 1950, but if we go all the way back even to 1940, we were at greater than 100 to 1 in terms of the number of workers that were contributing to the system. Recall that this is a pay-as-you-go system, so this system depends on the number of workers that we have per retiree or beneficiary. It was once at a healthy 100 to 1, 16 to 1 by 1950. By 2007, we've dwindled to about 3 to 1. And the projection is that by 2035, we're going to be down to 2 to 1. And that could be that's principally due to the aging of the population, right? We have the baby boomers, those born between 1946 and the 1960s, roughly, that they're hitting retirement age. We have more and more retirees per worker. So there's more strain on workers that are putting into the system. So the basic idea behind this dilemma or this financing challenge is that at some point we're going to need to dip into the trust fund. So currently we have an excess. We have a trust fund that we can dip into, but by 2017 we're going to need to dip into that trust fund. That's the projection, and then we're going to deplete that trust fund. Many experts will say we'll deplete that trust fund by the 2040s, let's say. So we have to do something before then, obviously, right? We have to do something either on the tax or revenue generating side or on the expenditure side to address this fiscal challenge. And so you'll note here some of the strategies that are proposed to respond to this financing challenge. You can check out this in more detail in your Donito textbook, but I just note some of the more major proposals. So first is to reduce the COLA. I noted that your primary insurance amount, your starting monthly benefit, is adjusted automatically for changes in prices. And we noted that the change in prices according to the CPIW from 2013 to 2014 was 1.5%. And so the proposal would be to take that automatic adjustment and to reduce that automatic adjustment by 0.5 percentage point. So instead of adjusting everyone's benefit by 1.5 percentage points, we could adjust the benefit by 1 percentage point would be the strategy, and that would fix X% of the problem. We're saving on the expenditure side. We would be giving out less in the way of benefits. The second proposal that's put out there is in terms of the benefit calculation itself. So currently we calculate benefits over the highest 35 years of earnings. And so the suggestion is to calculate benefits over the highest 40 years of earnings as opposed to 35. And so obviously that would dilute the benefit. So again, that would be an adjustment on the benefit side, pay out less in the way of the benefit to save money. We have another proposal here. That's to raise the retirement age. So the age at which we can claim full retirement benefits is 66. It'll go up to 67, but why not push it up even further to 70? People are living longer is the argument, or one of the arguments that's put out there. And so that would fix X percentage of the problem, the experts will note. And then Another strategy is to tax the benefit. We do tax the benefit for higher earners, not necessarily earners, but folks with higher income levels. We currently tax the benefit, so why not do it even more aggressively is a suggestion. Why not tax the same rate as private pensions? That's the fourth strategy here. And then the final strategy, one that tends to be popular among social work students, is to lift that cap, right? So we have a cap up to $117,000 currently. Why not lift that cap such that almost all earnings might be subject to the Social Security tax, not just up to that capped amount, right? Why not place the burden on wealthier individuals is the argument, and that would fix X percentage of the problem. So different strategies that are proposed. You can think back to the question that we had by the New York Times and tweaks that have been made over the years to respond to the financing challenge that's been recurring, that's been cyclical throughout Social Security's lifetime. But this is just note that this will be one of your your final exam questions, to think about how each of these strategies might affect different classes of stakeholders. What might be the effect of a particular strategy on workers? What might be the effect on businesses? And what might be the effect on beneficiaries? That's essentially your final exam essay question, or one of your final exam essay questions. And so you can check your Donito reading for some of those responses. And so that concludes the first part of this lecture. And so in the next part, we'll look at how the TANF program, how temporary assistance for needy families, how that operates. So we'll stop there for now.